If you are in pursuit of building an income portfolio for the sake of financial independence or retirement income, I have 3 recommendations to go over today that'll help you build a rock-solid income foundation. Hi, I'm Brandon, host of the Yield to Reason podcast, a show where we help you reach financial independence through income-focused investing. And today, I want to put 3 options on the table for your investigation as you build out your income portfolio. I have a deep amount of experience with all 3 of these options. In some cases, I've used them personally. In others, I have helped others with the process of setting them up to build solid, quality income sources for them, either as an additional income stream while they're still working or a retirement income plan. So kicking off the list, first up, closed-end funds. A closed-end fund is essentially a mutual fund that has a fixed number of shares that are issued when the fund opens, and that's it. They cannot issue additional shares to new investors like a mutual fund can, basically infinitely. Instead, the funds are issued through an initial public offering, and the shares are traded on the open market, just the same way you would buy shares in Apple or Microsoft. Closed-end funds have a regulatory obligation to return a certain percentage of their investment profits to their shareholders. So they've always been well known for their high yield as an investment. One of the most astute observations anybody ever made to me about closed-end funds is that they effectively do for retail investors what retail investors always hoped bonds would do for them. Most retail investors don't actually invest directly into bonds. They instead go through bond funds, which have for the most part been mediocre investment options. Closed-end funds, on the other hand, have performed quite well, both in the world of income and moderate appreciation. Now, there are a lot of different sector exposures you can get with closed-end funds. By far, the majority of options will sit in debt-style investments, think bonds. But there's a whole host of other strategies or sectors that you can invest in inside closed-end funds. Think large cap stocks or emerging markets. A personal favorite of mine is utilities because everybody's going to have to pay the electric bill. As you're researching closed-end funds and trying to figure out which ones make sense in your portfolio, one of the best tools I have found for this is CEF Connect. We'll have a link to it in the description below. It's a fantastic tool that you can get free access to. I believe there is a premium service that you can sign up for, but I never do. And you can use it to screen closed-end funds based on a huge amount of selection criteria. This can help you whittle down the list of options to the ones that make the most amount of sense to you. There are some people who like to argue against the use of closed-end funds, and the 2 common issues they bring up are fees and the use of leverage. So if you look at the fees as they are quoted in a quote for a closed-end fund, you might mistakenly apply that number like you would an expense ratio for a mutual fund or an ETF. That would definitely be a mistake. The fee of a closed-end fund is assessed against its gross income, not its account balance. So if you look up a fund and it tells you it has a 2% fee, that does not mean that for every $100,000 invested in the fund, you're going to pay $2,000. In fact, closed-end fund investors never see fees deducted from their account balance because, again, those fees are taken from gross income. And just to be clear, when you look up a closed-end fund quote and look at its distribution and its yield, those numbers are all discussed in net terms, which is to say after the fee has been applied. If a closed-end fund has essentially invested all of its assets and has more opportunities for investment activity, it needs to raise capital somehow to do that. And since it can't just issue more shares like a traditional mutual fund can, the mechanism that closed-end funds most commonly use in this situation is to borrow money. This understandably concerns some people who have a certain negative opinion on borrowing or leverage in general. But I want to be clear about the fact that closed-end funds that borrow money are not doing it in the fashion of purring feline borrows millions and millions of dollars to go out and write naked puts against GameStop. The scenario is much more closed-end fund borrows money where it's paying 4% on the loan, but it's doing it because it can buy a new bond issuance paying 6% and take advantage of that interest rate arbitrage. Yes, that's an oversimplification of circumstances, but that is the spirit of what most leverage use in a closed-end fund looks like. There is one risk that this leverage does pose to a closed-end fund investor. The higher the leverage amount used by the fund, the more apt that is to cause a reduction in distributions from the fund, which means yield has a higher probability of going down when leverage is really high at a fund. But one other thing to comment on about closed-end funds, in addition to their distributions, on average, you're probably going to find closed-end funds paying something under current conditions of about 10% yield on investment. This is, of course, subject to change as share prices go up or down. And these distributions are commonly paid monthly. So for those looking to build out an income plan where they're receiving monthly checks from an investment, closed-end funds certainly stand out as a great option. But in addition to all of that, a lot of funds end up paying special dividends, normally at the end of the year, once they've been able to figure out what excess profits they've been able to take from their investment activity. So if you're looking at a closed-end fund historical distribution chart and you see one year that the distributions seem really high, but then they go back down, that's most likely indicative of a special distribution. Next up on the list, annuities. Uh-oh, don't tell Ken Fisher. He said annuities. Actually, based on sales data from the industry, lots of people love, not hate annuities. But that being said, the one thing that annuities bring to the table that we can't overlook in good conscience is a rock-solid guarantee. The guaranteed income that you can derive from an annuity is a feature that is hard, if not impossible, to replicate with any other asset in existence. Also, some annuities in some situations have extremely high yields on investment. This is especially true the older you are. And the guaranteed income features of certain variable and indexed annuities make them really strong income options for people who are 5 to 10 years away from beginning an income stream. Annuities certainly aren't a fantastic option for those who are younger, just looking to add additional income streams to their life, but they can be a strong tool for retirees. So what I'm saying is, annuities are a great tool to use to build a guaranteed foundation of income. The expenses that you absolutely have to meet month over month. Social Security will absolutely play a role in that. But for a lot of people, it won't be enough. And annuities are a great option to fill in that difference. Understandably, annuities can be a little bit complex. They're not all that easy to compare. And you're certainly going to need an insurance agent at some point if you're going to buy an annuity. But for a very simplified income annuity purchase, you can use tools like immediateannuities.com to get a list of all of the top annuity carriers and their current income rates for any scenario of age and investment amount. The last item on our list is REITs, or real estate investment trusts. REITs operate, in a sense, somewhat like closed-end funds. They too have shares that trade on the open market, and they too have an obligation to return profits to shareholders. But, of course, REITs are heavily concentrated in one sector, the real estate sector. They've become somewhat unpopular in the last couple of years, largely because COVID put such a hamper on commercial real estate and drove a lot of REIT shares down. In addition to that, higher interest rates have pushed people away from riskier yielding assets like REITs, and in some cases closed-end funds, and into safer assets like treasuries. This drop in demand for REITs causes an understandable drop in price of shares, which does result in at least unrealized losses for people who were holding REITs prior to the move. But despite that, REITs have, in general, a very attractive dividend, and we shouldn't overlook Americans' seemingly insatiable desire for real estate investments. And for that reason, it's prudent to hold optimism that REITs are likely to bounce back quite substantially. And something else to ponder on the subject of REITs, if you happen to be the type of individual who loves the idea of real estate investing for the sole purpose of real estate investing, bless your heart, and you happen to be one of those people who doesn't have a ton of money to start building your real estate empire, but you're a little hesitant to dive into one of those sketchy start your real estate empire with no money scams you find on the internet. Spoiler alert, many, many, many have tried. Very, very few have succeeded. You probably won't be an exception. REITs are a fantastic way to get into real estate investing, start collecting some passive income with a relatively small amount of initial capital. Sure, you don't get to be the landlord who gets called up at 2 a.m. because the HVAC system isn't working anymore, but you'll still be able to take advantage of the American real estate system and benefiting from an investment in it. So closed-end funds, annuities, and REITs are three fantastic options to start building income either as a additional stream while you're still working or fantastically solid income while you're in retirement. I hope that you recognize that all three of those options have vastly different approaches and exposures to risk for the sake of diversifying your income streams and diversifying the various risks that you may face when it comes to income needs. While theoretically all three of them could stand completely on their own as an income source, and some people do approach it that way, you would be well advised to seek income sources that are diversified and are less apt to move in the same direction at the same time. So income investing is not just about trying to find the highest yielding asset and buying up as much of it as you can. Instead, it's about building a basket of income assets that have unique features they bring to the table that complement one another and can ensure that no matter the economic circumstances, you can continue to produce passive income for yourself, because that is the true definition of financial independence.